This is Chad Stayskull, President of Eagle Wealth Management with our Educational Economic Update for February 2018. In this month's video, I'm going to discuss some of the headlines that influenced markets in January, while hopefully adding some insight into what these developments could mean for you as an investor. January 2018 is now behind us, and stocks posted quite a positive start to the year. In fact, even anticipation of the first federal government shutdown since 2013 didn't derail markets. The S&P 500 and the Dow both had their best monthly performance since March of 2016, each rising over 5%. The Nasdaq gained over 7%, making January its best month since October 2015. Several details came out during the month indicating that strengthening economy is driving market performance. Initial readings of the gross domestic product showed the economy grew by 2.6% in the fourth quarter. Though smaller than projected, the increase still implies healthy economic growth. Corporate earnings data also suggests the economy continued to expand. During January, many companies released their earnings reports for the fourth quarter of 2017. By the end of the month, 81% of S&P 500 companies had shared their earnings data and beat expectations. Also, 83% exceeded their revenue estimates. In addition to growing corporate earnings, labor measures seem to illustrate that the economy is also advancing. The ADP employment report, it indicated private companies added more jobs in January than analysts expected. Further, fewer people filed for unemployment in late January, keeping initial claims close to a 45-year low. Unemployment currently sits at 4.1%. and could go as low as 3.5% by the end of the year, according to some estimates. Wages are finally starting to pick up too. According to the Labor Department, the employment cost index in the fourth quarter was 2.6% higher than the year before. This increase is the largest since early 2015. Examined together, you see a growing market, increasing corporate profits, low unemployment, and rising wages. But this positive news is not without risks. If the tight labor market leads to faster wage growth, inflation could increase. At this point, the Federal Reserve could start raising interest rates more quickly than anticipated. The Fed met at the end of January, and it decided to keep interest rates at the same for now. They did indicate, however, they expect inflation to increase over the next year. After years of inflation missing the Fed's 2% benchmark, the markets would have to decide how to react to prices increasing more rapidly. Ultimately, we have strong growth in corporate earnings on one side and the potential for faster than anticipated interest rate increases on the other side. Looking ahead, we'll continue to analyze the interplay between economic growth and inflation. Only time and data will tell exactly how these connected pieces will come together, but we'll work to keep you informed along the way. That's it for this month's Educational Economic Update. Please remember, nothing we talk about here is a recommendation. If you'd like to discuss your personal financial situation, please feel free to give us a call at 541-330-0220. We'd be happy to talk with you. Once again, this is Chad Stayskull with Eagle Wealth Management, signing off for the month of February 2018.